Hello, everyone. This is session 9 of DFIN 511. Today we'll be talking about financial institutions. We have a few questions that were submitted before the session, so as usual, I'll answer those first. And then if there are questions or comments from the group, we'll cover those and see where we are after that. So let me start with the first question. This question is, what are your thoughts on dollar or euro or pound locked Bitcoin wallets like the ones provided by Coinapult? Nice training wheels or something totally beside the point? You have a sort of hosted wallet, which is bad enough, but any deposits are immediately converted into dollars, so you avoid foreign exchange risk exposure, which would seem bad as Bitcoin is generally deflationary. On the same line of thought, what are your thoughts on Bitcoin Visa debit cards? Training wheels or a case of why would anyone want them? P.S. I got one, but only because I've been making loads of money mining Ethereum this year, and it gives a warm, fuzzy feeling when I buy something with the card. But unless you're a miner, I cannot see where that warm, fuzzy feeling would come from. Okay, very interesting. I have to say this is probably one of the few university courses on the planet where you get questions that include, I've made a lot of money mining Ethereum this year. So I love to see stuff like that. Let me take it one step at a time. And on the euro locked, dollar locked wallets, I think it's important to think about who this is addressing. So you're right, certainly if you're Andreas Antonopoulos, you're not going to be in a hosted wallet anyway, right? So it goes without saying that you're not even going down this branch of that tree of someone who is not going to manage their own keys, someone who's going to use an online wallet of some type. And Andreas was just tweeting again this morning that if you don't control your keys, you don't control your Bitcoins, which is consistent with what he says in this course. But obviously there are people who use Coinbase and other online wallets, so presumably this is a product for that customer segment to begin with. So that's a starting view, I guess, would be that's the customer segment we're talking about. In that context, so I get what I'm assuming is that who are comfortable with using a hosted service. So I take that off the table as part of the discussion. And then I think the question then becomes, is the fact that they're locking a value for you relevant in some way? The question asks, well, you're giving up the deflationary aspects of Bitcoin, aka the fact that Bitcoin, theoretically, if it's deflationary, will appreciate against other currencies. I wouldn't take that as a given, by the way. So I would separate that issue out. I've never understood what that has to do with transacting in Bitcoin. So if you want to have Bitcoin as a deflationary investment, the other way to think about it is the value of Bitcoin will go up. So you're allocating some percent of your assets to Bitcoin because you're hoping it'll become more valuable relative to everything else. That's fine, but that's almost a completely independent concept from transacting in Bitcoin. It's like the fallacy of that $10,000 pizza, where everyone says, oh my God, that's the well-known first consumer transaction in Bitcoin, where someone bought a pizza with Bitcoins. At the time, they had a very low exchange rate, and so the number of Bitcoins that it took to buy that pizza in 2010, I think it was, today is tens of thousands of dollars. But it makes for a great newspaper article, but I never really understood it as a concept, because if someone wanted to maintain exposure to Bitcoins after they bought the pizza, they could have just bought more Bitcoins 10 seconds later at the same price, replenished their Bitcoin stash. So if you're saying it is economically identical to say I'm holding 10 Bitcoins because I'm holding them for investment purposes, and I buy my pizza with $20 cash, or I use my 10 Bitcoins to buy $20 worth of pizza, and then buy 10 more Bitcoins with $20, right? So I see this in both directions. Some people say like, oh, Bitcoin will never succeed from a transaction basis because everyone's going to prefer to hold it because it's always going to go up. Well, who knows that it's always going to go up? But even if it did over long periods of time, it's not like it's going up every single second, right? It's going up over longer periods of time, so you could always buy and replenish. And so when I think of these accounts, I have this in the back of my head. So now, what are different methods, and again, assuming you're already into the online account, what are different methods that this could work? You could have Coinbase as it is today, that is Bitcoin denominated, and there you say, well, I just have, well, you could do a couple of things. You could just say, I have some Bitcoins there for transaction purposes, or I have all my Bitcoins there in the vault, and when I spend some, if I spend and don't replenish, then I am also reducing my exposure to Bitcoin. That's equivalent to selling some Bitcoins, getting dollars, and spending the dollars. I would expect to see a feature in these systems where someone says spend and replenish, and it's just one transaction. So let's say I simultaneously want to keep my online account to do a couple of things. I want to hold 10 Bitcoins, and I don't want to think about how to hold the keys myself. And occasionally I want to transact in Bitcoin, presumably because there's something for which transacting in Bitcoin makes more sense. And I always come back to this. There have to be usage cases where it makes more sense than using, let's say, your credit card. Otherwise, there's no real point to it on a transaction perspective. So let's say I'm sending money to my friend in Sri Lanka and I want to get him the money right away. Or let's say I want to do a sensitive transaction or a micropayment or whatever. So there, it's valuable to have some Bitcoins ready to go to do transactions. But if I had a policy that said, well, yes, I'm going to do transactions in Bitcoin, but also I always want to have 10 Bitcoins because I believe in it as an investment, because in the same way that I want to hold 10 shares of Amazon because I believe in Amazon as an investment. I think it would be very logical to have a feature that is, just like there is a send, there could be a send and replenish. And certainly the online wallets are capable of doing that. They have your bank account or credit card on file. So you could spend half a Bitcoin to buy whatever it is you're buying, and at the exact same moment, purchase half a Bitcoin from their exchange and refill your Bitcoin. There, you've effectively transacted in dollars from an economic perspective. So the number of Bitcoins you had when you started is the same number of Bitcoins you had when you ended. The number of dollars you had when you started is lower because you've spent those. And you've paid for it via Bitcoin because there was some reason to do that transaction in Bitcoin and not to do it with your credit card. The locked accounts seem to me like the reverse of this. So this says, I want to have Bitcoin available to do a Bitcoin-style transaction because there's some point to doing a Bitcoin-style transaction. And I don't want any exposure to Bitcoin from an investment perspective. Theoretically, I can see some people wanting that. It's probably not any early adopters because the early adopters tend to, right now I think more people that use Bitcoin or are involved in Bitcoin also feel that there is an investment aspect to it, not just, wow, I don't care about the investment aspect at all, and I'm super, super excited because there's all types of cool things you can do with it as a medium of exchange. There's not that many yet. We're still early in that process. But if there were, you could imagine some people saying, yeah, I want to have, I don't know, $100 worth of Bitcoin available because I needed to make micropayments or refresh my micropayment browser or what have you, but I don't want to think about exchange rates. I don't have an opinion if Bitcoin is going up, down, left, right, etc. I just want to be able to pay for things that require to be paid for in Bitcoin, and that's that. So I can see for that customer set that this makes sense. And read the deflationary point, I think that's almost irrelevant. If you want to hold 10 Bitcoins because you want Bitcoins for investment purposes, well, go hold 10 Bitcoins. No one's stopping you. You could have a locked account and also hold 10 Bitcoins. You could have an account in Bitcoins and use it for spending and replenish them. So I always thought these arguments were a little bit of a red herring, because if you're sophisticated enough to be using Bitcoin in the first place, it's pretty straightforward to say, I've decided that I want to own 10 Bitcoins, and regardless of what I do on my spending, I'm going to have 10 Bitcoins. I mean, it's not complicated. So that's the first part of the question. The second part of the question is the Bitcoin Visa debit cards. Those are interesting. They're kind of the opposite side of things. Those are, I guess, the way to think about them is, I want to keep all my assets in Bitcoin, but I want access to the card networks as a medium of exchange, because obviously the card networks are accepted at several tens of millions of places, and Bitcoin isn't at this stage. For whom is this valuable? I would actually suspect this is a smaller set of the population, because most people aren't going to take the position that I need to have everything in Bitcoin, right? So it's not totally clear to me why, for someone who plans to still have a US dollar checking account, why you couldn't deal with your normal debit card needs out of your US dollar checking account, and if you also wanted some Bitcoins for investment purposes, you hold that in your Bitcoin account, and that's that. So it strikes me that this is primarily useful, other than the cool value that you're spending Bitcoins. But this cool value thing is never going to scale, right? Like, no consumer is going to do anything more difficult than the alternative just because they're striking an ideological blow for Bitcoin. I mean, it's never going to happen. So the only segment that I think this is for is someone says, well, I don't want any exposure to dollars, euros, etc. I want to be 100% Bitcoin, but I do want to be able to go to my local deli and swipe my credit card, swipe the debit card. So I guess that is a segment, but it strikes me as a smaller one, honestly, in the scheme of things. So that's my thought on this. George, would you add anything to this?
It's precisely what you said, that the most ideal side of this is for those who want no exposure to checking accounts or the existing banking infrastructure, or might be some sensitive part of the population that don't want exposure to their spending for tax reasons, or that's about the reasons I can see as well. What I would like to comment on was, though, on the first part of the question, because if you remember, we had this discussion almost a year ago, and a year and a half ago, about the financial companies holding Bitcoins or euros and denominating a value in either Bitcoins, euros, or dollars, and the risk that this creates that sometimes people are not aware of, or potentially the fact that they're saying that they're buying Bitcoins so that they can take advantage of the speculation in the price potentially rising, but this at the same time creates risk from the counterparty who holds the actual euros and is expected to pay Bitcoins or the equivalent in value. And it's not just Uphold that does something in the same lines. and there's always some kind of risk involved. And I don't think either companies communicate this enough, and they should communicate to their customers where the risks lie.
Yeah, no, it's a great question. It's a very good point. I guess there's two ways that it could be done, and I actually went looking for this on the Counterparty website, and I didn't actually see it this morning. I wasn't sure, so I should have mentioned this. A risk-free way, if the company says, I am going to denominate your account in euros, the way that you have effectively little risk in that is if they actually convert your bitcoins to euros, and then just have a small pool of bitcoins available at any time so that they can do the transactions quickly, and then just replenish that pool as they use it up. There, they've matched their liability to you, which is euro denominated, with their assets, which is euros, and it should be relatively low risk. What would be bad, and it would be good to understand this, if someone says, yeah, you have euro denominated accounts or dollar denominated accounts, but the people holding the bitcoins haven't converted to euros or dollars, and they're hoping they'll take advantage of they're hoping Bitcoin will go up. They've committed euros to you, so their liability is euros, their asset is bitcoins, and if they're speculating with your money, if they're saying, well, I hope Bitcoin goes up, in which case I make that difference between the euro liability and the Bitcoin asset, that's really bad because you don't know for sure it's going to go up. It could go down. And if it goes down, their assets in bitcoins won't be sufficient to cover their liabilities in euros or dollars. And so I think that is an excellent question, an excellent thing that as a consumer of these services, you'd want to understand if there is a transparent framework on this. And, oh God, do I dare say this word? Probably want a regulator to look at them if this was a mass consumer product. I know someone's going to, Andreas will probably yell at me, I don't know. But like, how exactly as a consumer are you supposed to check this, right? If, and they could tell you they're not speculating, but if they're actually speculating, how do you see it? Someone has to actually be checking and it's tricky there because you're not checking their Bitcoin reserves, which they could possibly demonstrate that they have. You'd be checking their euro and dollar reserves, and if they have enough euro and dollar reserves to meet their euro and dollar obligations, which is complicated, right? You'd want to have some comfort that an external party with access to their financial information can go and say, yeah, this bank, because it's effectively a bank, right? Like it's effectively a deposit-only bank. Bank has actually reserves relative. It has assets to cover its liabilities. It's actually solvent. So you're right. It's an excellent point. I thought of it this morning, and then I forgot to mention it here, that one big question in all these cases is counterparty risk. Anytime you're not holding your assets directly yourself, you're effectively holding a liability of the other party. And if you're holding a liability of the other party, you want to know that the other party is solvent. And realistically, this is where bank regulation came from, right? It is tricky for consumers to go check the solvency of a bank, right? It's actually very difficult for banks and their regulators to check the solvency of a bank. Like, I don't know if people spend too much time thinking about this, but if you said, tell me what JP Morgan is worth, it is absolutely, certainly not a point figure that you can agree on. If George looked at it and I looked at it and like some other guy looked at it and some other gal looked at it and 20 people looked at it, we'd come up with 20 different values. Because what is JP Morgan? Well, there's hundreds of billions of dollars of assets and liabilities. And so the liabilities are things that they owe people. And some of those liabilities are easy to figure out. If they owe you $100 in your checking account, that's pretty easy to figure out that's worth $100. And then some of them might be trickier. Let's say they have a derivatives contract with someone that today it might be worth something and tomorrow it might be worth something different. And then they have a bunch of assets. The assets to a large degree are, well, there's also some obscure, there's more exotic assets, but a lot of them are loans. Well, how much are those loans worth? If you had made loans to a bunch of energy companies 2 years ago, when the price of oil was much higher, today the price of oil is much lower. Those energy companies are under a lot of financial stress. What are those loans worth? Are they going to get paid back? Are they going to get paid back 100%? Are they going to get paid back less than 100%? Are they going to get paid back on a timely basis? Are they going to get paid back later? All of this for just one loan is a whole project that is as much art as it is science. And then you take a giant financial entity, you don't even have to go as big as JP Morgan, even just your average regional bank, this would be true. But think of a big international bank. They have hundreds of thousands, no, what I'm talking about, tens of millions of assets of all different types, consumer, business, financial products, in all types of different geographies, in all types of different industries. What those assets are worth at any time, it is absolutely not like opening up your checking account and saying, I have $132.17 in my checking account. That I can tell you what that is worth today. What JP Morgan's assets are worth, there's probably a tens of billions of dollars swing, depending on who's looking at it and what assumptions they make. And that's not because anyone is evil. It's because it's actually a very hard question. If you've lent $100 million to some coal manufacturer, and now they're under some coal miner, and now they're under financial stress, is that worth $100 million? Is it worth $90 million? Is it worth $70 million? Who knows? Lots of people could come up with different answers to that question, and they might all be right. So that's why it's very difficult to say it's somehow the consumer's responsibility to know if an entity is solvent, unless you had if I look into the far future, if you had some type of blinded, transparent system that things were exposed and there could be crowdsourced analysis of them, yeah, maybe something like that would work. But certainly, Antonis Polomidis, who is pretty knowledgeable about how to make a financial model and pretty knowledgeable about how to value a security, if you told me I've got to be in the top 1% of likely customers of a bank or financial institution, and if you told me you have to make a determination before depositing your cash if institution X is solvent, it's laughable. I mean, it's laughable. You'd need like whole teams and teams of people with access to all the internal financials, and even then, the spread of values are going to come up with is like this. So, counterparty risk is a very, very tricky question because it's effectively a question of, is the counterparty solvent? And if the counterparty is a financial institution, the more complex it is, the harder it is to actually figure out if the part is solvent. And not only is it the question, is it solvent, is it liquid? Because you could have a bank run if you're solvent but illiquid. So what do I mean by that? Let's say I owe George $100 because he has a savings account at Bank of Polomidis, and I've lent all that $100 to a coal manufacturer coal miner who's going to pay back in 10 years because I thought George wasn't going to ask for his money back 3 years from now, and then George comes and asks for his money. Well, I might be solvent. I have $100. Maybe I have $101. I've charged interest. The $101 coming from the coal miner, I'm actually solvent to $1, but I might not be liquid because I go to the coal miner and say, I need the loan back. I say, I can't give it to you back now. I'm going to give it to you next year when it's due. Right? So there's a case where I'm solvent, I have enough assets, but as far as George is concerned, he can't get his money. And so these questions, solvency and liquidity, are complicated questions. Were you going to say something, George? Or
No,
okay.
I don't really have anything to add. It's just you explained properly that it's extremely hard even for those who are claiming that they are transparent and we can see their holds and their reserves. It's really very hard to corroborate any of this evidence with real data. And that's where the regulators should be coming in, and that's where a blockchain-based or Bitcoin-based structure can actually help the regulators review whether these holdings are there in a very deterministic manner, which perhaps will be easier to value at a specific point in time if that's what we're looking for. So that's one aspect where this technology could be helping the conventional financial structures.
Yep. Excellent topic. Okay, let's go to the next question. The next question says the following. In the last session, you pointed out that most Western countries today are struggling with deflation and not inflation. I am under the impression that most mainstream economists are claiming that deflation is a terrible thing for the economy. Bitcoin is different. It is actually designed to be deflationary in the long run. I have also heard people criticize this deflationary aspect of Bitcoin. They say Bitcoin will fail as a currency because of deflation. But I think I have heard someone claim that deflation is not an actual cause, but a symptom of a poorly functioning economy. How would you characterize deflation with regards to the following? Is deflation generally something that leads to a bad economy, or is a bad economy something that leads to deflation? Yeah. Okay, so this is a good question. We cover this every single MOOC, and we'll give it a shot this time as well. First of all, it is no law of nature that says you can create any asset that's deflationary. Here's another way to think of deflationary. Its value is going to go up. If there's any magical way to make something's values go up, we've invented the magic money machine, and we wouldn't be here doing Skype. We'd be buying private islands, right? Or Google Hangouts, sorry. Bitcoin is designed to, yes, not have an increasing number, to have a fixed number of units, but if nobody wants Bitcoins for whatever reason, it's not going to be deflationary. It's going to be deflationary because there's demand for it and the number of units aren't increasing to a degree greater than the demand, right? So now, let me accept for a second that Bitcoin's going to be deflationary. So now that I've done the caveat that, nothing is guaranteed to go up in value, let's say it is going to go up in value. Well, so long as Bitcoin is not the unit of account for a national economy, I think this has exactly zero impact on any macroeconomic issues. So let's talk about a different analogy. The shares of Amazon since 1999 have been highly deflationary. In other words, if you owned a share of Amazon in 1999 and you own a share of Amazon today, you can buy many more goods and services by selling that share for US dollars and then going and buying things than you could have in 1999. It is deflationary relative to all other assets in the American economy, or products in the American economy, and services in the American economy, or it's another way of saying its value has gone up. Bitcoin, as it stands today, is much more like a share of Amazon than as a national currency. So if you buy a Bitcoin today, and it's, I don't know, $430, and let's say it happens to go up in value, it deflates, and 2 years from now it's $550. Yay, you have generated a larger claim on the assets of the American economy, because you can change that back for $550 and buy more goods and services that you could have at $430. But this has zero macroeconomic implications for the U.S. economy. There are all types of assets going up and down in value all the time. Real estate goes up and down in value, stocks go up and down in value, bonds go up and down in value, oil goes up and down in value, farmland goes up and down in value, forest land goes up and down in value. None of them, including asset classes that are much, much, much bigger than Bitcoin, have any effect on the deflationary, inflationary aspects of the U.S. economy. The U.S. stock market is trillions of dollars. The U.S. bond market is even bigger. But you don't go to the store and buy milk denominated in shares of Amazon, right? Shares of Amazon are not a unit of account. So let's think about what this means. The folks who are saying Bitcoin would be a problem for the economy because it's deflationary, are using some type of mental analogy like this, that, oh, well, we're going to say milk is worth a gallon of milk is 1/100th of a Bitcoin, and Bitcoin's going to go up in value, and so then the price of milk will be falling in relation to Bitcoins, and we'll talk about why that's a bad thing in a second. But that's literally like saying it's as plausible to happen today as saying milk at the deli is going to be priced as 1/100th of a share of Amazon. And then tomorrow the shares of Amazon go up because they had a good quarter, and now we have all these macroeconomic complexities when we're buying milk. Huh. That's not in any danger of happening anytime soon, right? Like, this is Bitcoin's market capitalization is single-digit billions. There are individual companies in the United States whose market capitalization is hundreds of billions. One company. So worrying about the deflationary aspects of Bitcoin if it becomes the unit of account of the United States, when there are asset classes that are vastly, 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 vastly bigger than Bitcoin that have not become the unit of account of the United States of America, just like, shares of Apple are not the unit of account, and the S&P 500 is not the unit of account, and the bond market index isn't the unit of account, or the real estate price index, which is, I think, the largest asset class in the United States, is not the unit of account. You don't go buy shares, you don't go buy milk denominated in shares of housing of the United States. It's like worrying about what happens, which dunk will Antonis use to win the All-Star dunking contest. Given that Antonis can't even touch the rim of the basketball hoop, it's a completely irrelevant problem to worry about, right? It's not like I'm going to do a backward dunk, a forward dunk, an alley-oop dunk. I can't even get above the rim. And that's going to be true even if Bitcoin goes up in price 100x from where it is today. 100x from where it is today, it's one big company on the stock market. So that I put in the bucket of problems that nobody needs to worry about the next 10 to 20 years. Now let's go to the second question. Why do economists worry about deflation? Let's walk through the following analogy. Let's say we knew for sure that deflation was going to be, and let's give it a high number, because I think it will be much more clear if that's the case. Let's say we knew for sure that deflation was going to be 1% a month forever. Okay, so what does that mean? That means a month from now, everything's going to be 1% cheaper. So let's say you were going to buy a beautiful suburban house somewhere in America, 5 bedrooms, 4,000 square feet, yard, fence, all this exciting stuff. And today the house is $1 million. But on, what's the 15th? On May 15th, it's going to be $990,000. So you say, well, I can wait another month to go into my dream house. I'm going to make 10 grand. I'd wait another month if I knew for sure it'd be 10 grand cheaper. So you get to May 15th. And now in a month, it's going to be about $980,000. So you say, wow, that's interesting. I can wait another month. It's another 10 grand in my pocket. Who'd want to waste 10 grand? And let's say that's true for the house, and let's say that's also true for, I don't know, the nice rug you were going to buy to put in there. It was $1,000 today. Next month it's going to be $990. Next month it's going to be $980. Next month it's going to be $970. So what that does is it puts a huge brake on consumption. And that potentially triggers the following feedback loop that's very negative. If everyone sees this, everyone says, right, everything's going to be cheaper next month. Forget it. I'm not going to buy anything next month. I'll buy anything next month. What happens to the people selling things, which is, in aggregate, everyone? You're trying to sell a house. You're trying to sell, you got to move to California, you got to sell your house. Nobody's biting because everyone knows the price is going to go down. You're a rug seller. You sell beautiful rugs. Nobody's biting because next month they know the price is going to be lower. Well, eventually, as a seller, you're not selling anything. You have a retail store, you're trying to sell your house, whatever, you're not selling anything. You panic, you need to stimulate sales so that, like, you don't go out of business this month. So what are you likely to do in that case? You're going to drop the price. So you're going to try and get ahead of it. So if they're saying, well, it's going to be $9.90 next month, I'm going to put my thing to be $900 to really force someone to buy. To say, like, oh, you can get it now for the price you were previously thinking was going to be the price a year from now. Maybe that'll stimulate, and that'll probably work for the first guy who does it. But then what happens? You're now establishing that deflation is even higher because all your competitors are going to do it. The new price is going to be $900, and now people are saying, oh my God, it's going down 10% a month. Well, if the price of everything is going down 10% a month, well, I'm definitely going to wait. And then demand really evaporates, and so people cut prices some more. And so you have deflation at substantial levels has this weird effect that it can put consumption, which drives any modern economy. It's about 70% of the U.S. economy, for example, is consumption-based. And the rest are various things like capital investment or what have you. But it puts consumption into this crazy downward spiral where eventually nobody's transacting for anything. And that's not actually good because our real wealth isn't in what our money says it is. Okay? One of the hardest things for people, money's not real, not really real. I mean that not just for fiat currency. It's also true for gold. All this stuff is, the society's true wealth is the amount of goods and services it can produce, times the quality level at which it can produce them. If all of a sudden, here's a way to think about it. Let's say I gave George $1 million in gold bars. And then, nice. And then I got in my time machine and took him back to the Stone Age. He might be the richest dude in Stone Age Greece, but his quality of life would plummet. He'd probably die of the next infection he got. His teeth would rot. He certainly wouldn't be sitting here with a computer. He wouldn't have electricity. He wouldn't have refrigeration. He wouldn't have anything. So yeah, he'd be the big man on campus, but every single consumer thing he takes for granted wouldn't exist. So the real wealth of a society is what actual goods, services it can deliver to people. And so when economists see these downward deflationary spirals that effectively stop consumption, which stops production, which then leads to unemployment, which unemployment is like telling a segment of your population, just hang out and do nothing. We can't think of anything productive for you to do to increase the wealth of your nation. Well, that's ridiculous. Right? Like, there's almost certainly something useful they can do. It's just a breakdown in the mechanisms of generating demand for those services. And so in these big deflationary spirals, they're actually very, very bad for moving an economy forward. Now you can say, well, isn't inflation problematic too? It is at high levels. It is at unexpected levels. But it's not as bad at low levels. Central banks target 2% inflation. Okay? So what does that mean? It means every month the price of something goes up about 0.2%. Okay. Why is that like an interesting place to be? It's a pretty good balance between, hey, day-to-day prices aren't changing too much. You don't have to go readjust people's salaries all the time, right? You don't. If inflation was 20% a month, you'd probably want your salary to go up 20% a month. That's annoying, all right? So people's loans don't get out of whack with their income, et cetera, et cetera. Things on the whole, 2% doesn't change much. It's close, to being zero. Prices are stable, wages are stable, etc., etc. However, it is a very slight positive push to say, other than all else being equal, you might as well buy that house now. You might as well buy that rug now. It's not a huge push. They're like, oh, I should buy it now because my money is going to be worth 10% less next month. But we're probably worth a little bit less. Just very fractional, a little bit less. And it keeps you away from the deflationary. And there's almost no negative implications to a low positive rate of inflation. You always see these like fun charts of people saying, well, the dollar in 1950, the dollar of 2015 is only worth 10 cents the dollar of 1950. And my reaction to that is, so what? Everyone knows that we're targeting a light inflationary environment. If you are keeping the majority of your assets in dollars, in cash, for 75 years, well, frankly, you're an idiot, right? Like, cash is for your day-to-day consumption and your emergency spending. Maybe you have 6-12 months of your life in cash. Given that inflation is 2% a year, that's no big deal. If you somehow, the number of people who had $10 million in cash in 1950 and left it in a checking account for the next 75 years are close to nil. Those people that had $10 million went and invested in assets that are relatively insensitive to inflation. They bought stocks, they bought bonds, they bought real estate, they bought commodities, and those things it's a whole topic of how those assets react to inflation. But nobody's leaving their majority of their net worth in cash. Cash is a medium of exchange. It's a unit of account. If you're keeping inflation at low positive levels, it is probably the optimal place for inflation to operate within cash. If separately you say, well, I'm going to make money by investing in Bitcoin, great. But that's totally the same as saying I'm going to make money because I think Amazon Web Services is a great service and they're going to dominate cloud computing and I'm going to buy a share of Amazon. So deflation, and to answer the final part of the question, is deflation a symptom or a cause of a bad economy? And it's both. Okay? When an economy is weak, deflationary pressure tends to come in because people draw back their spending. When people draw back their spending through the laws of supply and demand, prices tend to go down, right? Like at any given supply point, if demand is reduced, prices go down. If demand is increased, prices go up. So it is triggered by a weak economy. That in and of itself is no big deal, right? Like if you, let's say in a really hot economy, inflation was 3.5%, and in a cold economy, inflation was 1%. Well, 1% is more deflationary than 3.5%, but neither one of those two are problematic because there's still low positive levels of inflation, and they won't trigger this like spiral loop. If, on the other hand, there's a big demand shock and deflation falls to negative 3%, then standard modern economists would say, now you have a problem where deflation is now going to contribute and enhance the negative economic cycle and make the cycle even worse. Which is why they'll then do things like quantitative easing or encourage deficit spending from the government to say, let's fill in the demand that has been lost by the business cycle so we don't get stuck in this deflationary negative cycle. So I think I've covered it there, and I think it's there's really two different topics embedded in that question. Okay, last question. Bitcoin does not appear to be an acceptable unit of account or medium of exchange because of the fluctuating price expressed in fiat currencies. There is an altcoin called TerraCoin that was created to address this problem but turned out to be a total failure. Do you think any kind of altcoin could take this role? What should be the main features it should have. And then there's a couple of follow-ons to this. How large a role do you think regulations in financial services play as a barrier to entry and reducer of innovation? How does a payment processor like BitPay work? How do they set the currency rate? I think Bitcoin is not a unit of account today. I think it can be a medium of exchange because you only need to be exposed to Bitcoin for a short amount of time for you to do the exchange, and people are able to price that risk at less than 1% of the transaction. And so I think it's perfectly fine as a medium of exchange. I agree it's not a unit of account. I disagree. I agree that no altcoin, no private altcoin is going to be can provide credibility that it's going to be tied to the exchange rate of any fixed currency. The only people who could make a cryptocurrency that tracks the value of a national unit of account and have the ability to keep those in line are the central banks. So if the Federal Reserve said, I'm going to have FedCoin, and there are 50 million, and I'm going to let loose 500 million FedCoins, and I will always buy them at $1, and I'll always sell more. I'll always sell them at $1. You can come and buy and sell at $1 whenever you want. That coin would track very, very closely to $1, because if it fell to 90 cents, people would have a free arbitrage. They could go buy it for 90 cents and run to the Fed and sell it for $1. If it went to $1.10, people would also have a free arbitrage. They'd go buy it from the Fed at $1 and go sell it at $1.10. So that a central bank is very credible to do that. I think they will in time do that. I think it's going to happen in time. I would not trust a private provider to do that because the only person who can have unlimited flexibility in a national currency is the central bank itself that can create or destroy the currency as it so chooses. Regulations are a barrier of entry and a reducer of innovation for financial services cryptocurrency. I think that's absolutely true. I also do not believe regulation should be zero. I think that's also true. I think the best approach, the part that I think is the most annoying part is not actually the regulations, it's the fact that banks are refusing to bank a lot of Bitcoin startups. And that seems like a rather unfair form of competition. I like what Singapore did. They said, this is our strongest bank. This is going to bank the Bitcoin startups. We give it explicit permission and authority to do that. And we're also going to have regulations, but it'll work with the best run parts of our existing system, as opposed to saying, here's regulations, plus we're going to make your life totally miserable in terms of actually access to the banking system, which you probably need to run a lot of these firms. So the right level of regulation, very complicated question. We'll talk about it next week, and even then it's not sure I know the answer. How does a payment processor like Bitcoin work? How do they set the currency rate? In theory, it's somehow related to the exchange rate that's happening right then in the global exchanges. They don't track it exactly. They add some margin for themselves there. And, this is an area where you'd like to see more price transparency from different, an application that's going to use these different payment processors. It would be good to see, hey, what is the exchange rate that everyone's offering at that point in time? Like, if you go, it's really interesting. If you go send money from Coinbase to pay for something that's a BitPay processed transaction, the exchange rate you get leaving Coinbase is not the exchange rate you get getting BitPay. It's kind of amusing. So I think there's a little bit of opaqueness there relative to what it could be. All right, we have run. I know we started a little bit late because of technical difficulties, so we're ending a little bit late, but I think we're about on time. These were the questions that had been submitted. I hope we covered them well. And are there any other last thoughts before we sign off? Okay, awesome. Well, thank you very much, everyone. Have a wonderful weekend, and we'll see you next week.